I think the big question on everybody's mind, has something changed over the last, say, couple months where before now, everybody's kind of just been waiting. We know commercial real estate's going to be a problem. You and I talked about this before, but has something changed over the last couple months that would represent maybe the start of something going on?
Yeah, it's a good question. Well, first of all, commercial real estate is a troubled asset class. There's no question. I mean, all you have to do is look at what interest rates have done. So, and the entire value, the capitalization rates or cap rates, all of that stuff is based on what people are willing to pay, and obviously what that largely has to do with what the rates are. So this has been going on for a while, Jeff. It's not for me. It's not a surprise at all. The I think what's I'm dealing with this every day. We're on the phones almost every single day. We've got about $2 billion in assets, and we're on the horn with a lot of our lenders, and actually I'm flying to New York in 2 weeks to talk to many more. And so what's happening is the banks have already pulled back. So if I'm going to try to buy something today, let's say, we're looking at 55% loan to value. Now, so the banks, that's obviously what a lot of people would call a sign or a red flag, So they, just to put that in perspective, that would have been 65, 70, 75%, just a couple of years ago. So a lot of these loans are coming due. And so you've got maturity, obviously, is an issue for both debt and for equity. And don't forget, a lot of the equity that is in some of these, let's just pick on the commercial office buildings. Those buildings typically have managed equity. So if you're looking at a tall building like this and you have a capital stack, let's say, the first, let's say 50 to 60% is debt. The next percentage is various forms of equity. Well, that equity's gone because interest rates have gone up and cap rates have also gone up. So currently, there's not enough value to support the debt. And that's the real problem. And what we just saw in 2023 is it all got exposed, and people have now run out of cash largely, and they're doing cash calls, and people are coming in trying to save these things, and the new investors or new investment groups are trying to figure out, do they even want to be in these deals or not. Most of them they're passing on. And so what's happening is this is just a natural progression. If a bank has a loan that's due, the value of that loan is higher than the value of the property. That's the situation. And we are, in my opinion, if this is a 9-inning game, we're in inning 2 or 3.
Yeah, I think that's what most people. I don't know if that's their sense or if just lack of information. It kind of feels like it's early in the process. But I wonder how many people are just kind of, fingers crossed, hoping everything goes really well.
Yeah.
Because it's just, hey, if we don't hear anything bad, then it must be going okay. But what you're saying is that, we're still trying to work out what really where the trouble spots are. And from what you just said, I think the alarm bell that rung in my head is that even the investors who do have liquidity, who do have cash, are saying, we're kind of sitting on the sidelines. Let's kind of see where everything goes and wait that out. Which, I mean, if you're an investor who has cash, you don't want to buy now. You want to buy when everything goes down and come in and pick up on all the bargains. So
Right. It's a good time to look. It's a really good time to look because there's distress, and when you're not going to be able to buy it from the partnership because they're going to try to save themselves and save the equity. So the process really needs to be just like it was in 2008 when I went through this. First the equity has to go. And that's going to make its way into the 401ks, pensions, retirement plans, insurance, all that stuff.
And would that require a wave of foreclosures or some kind of public signal that this is going on? Or can this be worked out in private? Can it be like just a bespoke arrangement? Will we get a sense that this process is moving in that direction?
That's a great question. It's going to be done mostly privately. It's going to show up, however, in obviously people's statements, in their quarterly statements. And, I don't think, people really understand it. There's nothing that can be
nobody
fixed.
understands this at all. It's a really opaque process, which is why we're all kind of looking for help
Yep.
here.
It can't be fixed. And here's why. The only thing that can fix it, Jeff, is lower interest rates. That's it. Because what happens is the values, when rates got down to basically zero, it created a bubble, and people bought at that price. It's really that simple. And so the prices were significantly higher 2 years ago, and I would say that they're 20 to 30% less, maybe even 40 in some cases. And it depends on the asset class. But so if you're a long-term holder and you're cash flowing, it doesn't really even matter. It's almost like buying a home and you're still making the payment and the value went down. It's not a big deal if you don't have to sell. It really isn't. And the issue becomes if the loan or the debt matures, so mostly on the loan side. So those commercial banks that lent, and mostly these are small and regional banks that lend on this money, they are exposed significantly depending on what they've loaned into. So if they've loaned into the office building market, that's getting clobbered because of the work from home and, the vacancies. I mean, I was talking to a guy this weekend. He had an office building in San Francisco and one in Phoenix, and his rent was $1 million a year. And he wasn't even going there because his employees now all work from home. So he's just waiting for those leases to burn off. And so you're starting to see these leases burn off, and there's a lot of folks that they've changed the way they do business, and they're not going to go back into these office buildings. What that does is it lowers the occupancy, of course, and lower occupancy means lower revenue, and so now they're going to struggle paying just your normal expenses, which are taxes, insurance, utilities, and all that, in addition to the mortgage. So, there's a certain break even on these buildings, and they're probably in the 50 to 70%, depending. Now that would be debt plus expenses, and once you start to get your revenue below that, you're in default. And so that's